Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Rocket Lab.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and today we really have a fascinating situation to look at.
We absolutely do. I mean, imagine a company trading at this massive premium, right? Like roughly 60 times its revenue.
Right.
And they are bleeding almost $200 million a year, yet somehow Wall Street and the U.S. Department of Defense consider them to be, the most critical safety net in the entire aerospace industry.
It sounds contradictory when you just look at the raw number.
Exactly. It's a complete paradox.
Yeah.
Because for the longest time, investing in space meant you were just throwing money at speculative startups, right?
Yeah, high risk, astronomical cash burn.
Tons of cash burn. And like a lot of very pretty computer-generated renders,
Yeah.
but zero fundamental business stability.
Right, but looking at the recent data, that narrative is completely shifting for this specific company.
Totally shifting. We're watching them transition from, just a niche small launch provider into this high-growth infrastructure and defense staple.
The evolution here is structural. We are no longer looking at an experimental venture trying to prove a physics equation.
Yeah, not at all.
We are analyzing an established defense prime contractor. They are scaling operations, fortifying their balance sheet, and just absorbing a massive influx of both commercial and government demand.
Yeah, and before we even touch on the crazy market momentum or the stock price action, we really need to look under the hood at the actual business metrics.
For sure. The fundamentals always come first.
Right, because the numbers driving this momentum are substantial. I mean, they just closed out fiscal year 2025 with a record revenue of $602 million.
Which is huge.
It's a massive 38% increase year over year.
What's fascinating here is the forward-looking visibility that revenue growth implies.
Yeah, tell me about that.
Well, when you analyze their Q1 2026 guidance, it points to an annual revenue run rate rapidly approaching $800 million. Oh. And in the aerospace sector, where, manufacturing bottlenecks and launch delays are notorious.
Oh, yeah, things get delayed all the time.
Right, so achieving that kind of top-line velocity indicates a highly optimized production line.
And what truly guarantees that visibility for them is the backlog. I mean, they are sitting on a staggering $1.85 billion backlog right now.
It's incredible. That is essentially 3 full years of revenue visibility legally locked in through contracts.
Yeah. But here's where it gets really interesting. The actual engine of this company, the thing making the most money, isn't even launching rockets.
No, it's their space systems segment.
Right. It makes me think of like selling shovels during a gold rush, right?
It's a perfect way to look at it. The launch vehicle gets all the media coverage, but the underlying components are where the real structural margins live.
Exactly. Instead of just focusing on the highly visible, highly volatile business of setting a rocket up, they are building the ecosystem.
The solar panels, the star trackers.
Yeah, the reaction wheels, the flight software. And that space system segment makes up 74% of that massive $1.85 billion backlog.
And it's pulling in gross margins of over 30%, which is just incredibly healthy for hardware.
Wait, hold on, though. Let me push back on this financial picture for a second, because there is a glaring contradiction I want you to explain.
Okay, what is it?
I'm looking at their fiscal year 2025 net income. They posted a net loss of $198 million.
Right.
So if Space Systems is this massive cash cow you're describing, and they just finished a massive $1 billion at-the-market equity program.
The ATM program, yeah.
Right, the ATM, which completely removed the threat of near-term dilution. But with all that, why is the bottom line still almost $200 million in the red?
I get why that looks alarming.
Right, how does this lead to profitability if they are still burning cash that aggressively?
Well, it really comes down to a deliberate capital allocation strategy. Those consolidated margins are just temporarily suppressed by aggressive research and development expenditures.
Oh, the Arnie burn.
Exactly. Specifically, the capital from the ATM and the cash flow from Space Systems are being heavily diverted into developing their next-generation medium-lift rocket Neutron.
And the Archimedes engine that powers it.
Yes, exactly. They are choosing to operate at a net loss today to fund a massive leap in payload capacity.
Okay, that makes sense.
Once the heavy R&D phase for Neutron peaks and begins to roll off the balance sheet, The underlying profitability of that 30+% margin space systems business will just immediately flow through to the net income line.
Got it. So the core business is highly functional. It's just masked by the immense upfront cost of building their next major asset.
Exactly.
And that ties directly into how they are building out their competitive moat, right? Because healthy margins and massive backlogs don't just happen by accident.
No, they take years of strategy.
Yeah, they're building a vertically integrated one-stop shop model. They design the satellite, manufacture the internal components, and then provide the launch vehicle.
That vertical integration is the absolute key to lowering their internal costs and controlling their own supply chain.
Which is vital right now.
A perfect example of this manufacturing scale is the recent unveiling of the gas thruster.
Yeah, let's talk about the gas thruster for a second, because the technical mechanics here are super important for you to understand.
It's a game changer for them.
Right. A thruster like this isn't the giant engine pushing the rocket off the launch pad. It's a smaller propulsion system attached to the satellite itself.
Right. For maneuvering once it's already in space.
Exactly. Whether that's avoiding orbital debris, maintaining altitude, or staying in formation. And Rocket Lab announced they have the manufacturing scale to produce over 200 of these gas units per year.
Producing spacecraft engines at that volume is practically Henry Ford assembly line territory for the aerospace industry. It's unheard of.
It really is. And they aren't just building internally, they're aggressively expanding through M&A strategy too, right?
Oh, absolutely. The recent buyout of Mynaric is a critical pivot into the defense stack.
Mynaric, they do the laser communications, yeah.
Yes. Traditionally, satellites communicate using radio frequencies, which can be intercepted, jammed, or spoofed by adversarial nations.
Which is obviously a huge security risk.
Exactly. But laser communication utilizes focused beams of light to transmit data point to point.
So it's much more secure.
Vastly higher bandwidth and inherently secure because an adversary cannot easily intercept a pinpoint beam of light in the vacuum of space.
So by acquiring Mynaric, they essentially bought their way into securing highly classified, high-bandwidth military contracts and grew their European footprint at the same time.
Spot on. And speaking of the military, the Department of Defense is heavily relying on their HASTE platform, too.
HASTE. That stands for Hypersonic Accelerator Suborbital Test Electron, right?
That's the one. Basically, the U.S. government is in a massive arms race to develop hypersonic glide vehicles.
Right, and they urgently need a way to test them.
Exactly. HASTE takes the reliable booster of their standard rocket, but instead of putting a satellite into orbit, it flies on a suborbital trajectory specifically to test those hypersonic payloads.
And it currently boasts a 100% mission success rate, which is just wild.
It's vital. If you are the Pentagon, putting a classified $50 million experimental payload onto a rocket,
You aren't going to risk moving to an unproven, cheaper competitor.
exactly, you go with the one that works every single time. That operational reliability creates an almost insurmountable switching cost for the Department of Defense.
Okay, let's unpack this dynamic, though. Because despite the gas thrusters, the laser communications, and the perfect hypersonic testing record,
Yeah,
they are universally recognized by the market as the second source to SpaceX.
that is true. They are the clear number 2.
Right, they have a regulatory moat, sure.
Yeah.
They leverage the Five Eyes intelligence alliance, between the US, UK, Canada, Australia, and New Zealand
Right.
to block foreign competition. But they are definitively number 2. So my question for you is being the number 2 to a behemoth like SpaceX actually a sustainable business model? Or are they just surviving on the table scraps that SpaceX is too busy to bother with?
That's a great question. If we connect this to the bigger picture, being the established second source in national security infrastructure is actually one of the most lucrative positions a company can hold.
Really? How so?
Because for the United States government, relying entirely on a single monopoly for access to space is a massive strategic vulnerability.
Oh, I see.
Imagine a scenario where SpaceX experiences a systematic anomaly that grounds their fleet, or a severe launch pad explosion.
Or even of a protracted regulatory dispute.
Exactly. The United States military cannot allow its satellite deployment capabilities to be frozen. They fundamentally require a backup plan.
So they require a viable domestic competitor.
Yes. The Space Force and the Pentagon will intentionally award massive multi-million-dollar contracts to a reliable second source simply to ensure that company survives and scales.
Wow. So being the second source means you are functionally mandated to succeed by the government.
Precisely. It is the guaranteed receipt of billions of dollars in strategic diversification spending.
That completely flips the narrative. I mean, they aren't fighting for scraps. They are an insurance policy for the U.S. government.
And Wall Street is clearly pricing in that operational moat.
Yeah, let's talk about Wall Street's orbit, because the technical momentum of this stock is behaving unlike anything else in the sector right now.
The price action is exhibiting a textbook structural breakout.
It really is. Right now, the stock is trading in a powerful uptrend, sitting roughly 23.4% above its 200-day simple moving average.
That shows immense long-term institutional accumulation.
Yeah, and for you listening, moving averages smooth out daily price volatility to show the macro trend. Being that far above the 200-day line is a huge bullish signal.
It's also finding strong immediate support around the $64 level.
Right, while actively testing key resistance up near $78.50. And we are seeing highly unusual options and equity volume being flagged in the industrial sector.
Whale activity.
Exactly, whale activity. This isn't just retail day traders pushing the price around. Mega-cap asset managers are building massive positions.
Because they recognize that shift from a speculative startup to a foundational defense contractor.
Yeah, and the analyst upgrades reflect that too. We are seeing major firms heavily bullish. Roth Capital raised its target to $100.
Eden went to 95.
And Cantor Fitzgerald to 85. They're assigning it the kind of scarcity premium you usually only see for monopolistic software companies.
Well, there is also a massive macroeconomic catalyst driving this sector-wide re-rating.
The SpaceX IPO, right?
Yeah. The market is actively front-running the anticipated SpaceX IPO, which is pulling massive speculative capital into pure-play space names.
So what does this all mean for the listener? I mean, with this SpaceX halo effect, are investors buying Rocket Lab on its own merits, or are they just desperate to get a piece of the space economy before SpaceX goes public?
It's a combination. The anticipation of a SpaceX IPO paired with massive government initiatives like the Artemis II lunar mission.
Oh yeah, and the White House memorandum on space nuclear power.
Exactly. Those macro events are acting as a rising tide for the entire aerospace sector. Investors realize the space economy is maturing decades faster than previously modeled.
Right.
However, Rocket Lab is capturing a disproportionate share of that speculative capital because of the fundamental track record we just outlined.
Because institutions can't just throw billions at unproven concepts.
Exactly. They require the safety of a $1.85 billion backlog,
Wow.
vertically integrated manufacturing, and those laser communication defense contracts. The SpaceX IPO creates the enthusiasm, but Rocket Lab's execution retains the capital.
Okay, so we have painted a very bullish picture here. An 8 out of 10 bullish score, a sky-high valuation, defense mandates.
Everything looks great on paper.
Right, but when a stock is trading at these nosebleed valuations, we have to look at the immediate upcoming events that will either justify this premium or bring the stock crashing back to earth.
We definitely need to look at the risks.
So what does the launch pad look like for the next few months, and what is the bear case?
Well, the most immediate fundamental catalyst is their Q1 2026 earnings report, scheduled for May 7th, 2026.
Okay, and what are the estimates?
Consensus estimates are projecting revenue of $191.07 million for the quarter.
Which is a huge jump.
Right, and they are projecting improving earnings per share, indicating that the bottom line profitability is beginning to materialize.
But the financial engineering only matters if the physical engineering works, right?
Exactly. And that brings us to the imminent neutron rocket hot fire test.
This is critical. A hot fire test involves taking the newly designed Archimedes engine, bolting it securely to a test stand on Earth, and igniting it for the exact duration it would take to reach orbit.
You are proving the engine doesn't melt, vibrate apart, or suffer pressure failures under extreme stress.
Right. When that Archimedes engine completes a full-duration hot fire, it will instantly eliminate a massive amount of technical risk for the entire Neutron program.
In tandem with that engine testing, they also just successfully passed qualification for their Hungry Hippo captive fairing.
Oh, the Hungry Hippo. I love that name. For context, the fairing is the massive nose cone at the top of the rocket that protects the satellite payload as it punches through the atmosphere.
Usually they just split in half and fall into the ocean, which is incredibly wasteful.
Yeah, but a captive fairing essentially opens its jaws to release the satellite, but stays firmly attached to the rocket booster so the entire assembly can return to Earth and be reused.
Passing that qualification is a massive step toward vehicle reusability.
It is. But here is the bear case we absolutely must address. The stock is currently trading at a steep 60 times price-to-sales scarcity premium.
Yeah, that multiple essentially prices and flawless execution.
Exactly my point. If you are trading at 60 times your revenue, The market isn't just expecting growth, it is demanding perfection.
Right.
And their flagship future product, the Neutron rocket, has already seen its maiden flight slip into the fourth quarter of 2026.
That delay is a concern.
Right, so if Neutron is delayed again into 2027, or worse, if that Archimedes hot fire test fails catastrophically, doesn't that completely destroy the narrative?
They would be bad.
I mean, doesn't a delay present a massive risk to the stock's multiple, causing severe multiple compression?
You are identifying the single greatest risk to the equity pricing. A failure on the test stand or a multi-quarter delay for Neutron would cause institutional investors to violently reprice the asset.
Yeah, the downside would be steep.
Very steep. However, the mitigation to that execution risk lies entirely in the backlog.
The $1.85 billion we talked about earlier.
Exactly. That multi-billion-dollar backlog is not dependent on the Neutron rocket.
Oh.
It is driven almost entirely by their existing, highly reliable Electron launch vehicle and that incredibly profitable space system segment.
So they don't need Neutron to fly tomorrow to generate near-term cash flow.
No, they don't. Neutron represents the massive upside catalyst for capturing the medium lift market, but the valuation floor is protected by a multi-year pipeline of contracted work that is already executing flawlessly today.
So as long as they keep capturing those DoD contracts with existing assets, a Neutron delay is just a manageable headline, not an existential crisis.
Precisely.
So, bringing all of these threads together, if you are listening to this analysis and trying to determine your strategy, what is the ultimate elevator pitch thesis here?
The thesis is that this asset is a multi-year hold, successfully transitioning into a defense prime.
Right.
They are firing on all operational cylinders, fully funded from the ATM, and poised to benefit from massive macro-space tailwinds.
It's just a phenomenal industrial transformation to witness. And it leaves me with this final provocative thought for you to ponder long after we sign off today.
What's that?
Well, we currently think of space as this emerging sector, right? Like it's some fun, futuristic niche in the market.
Yeah, a lot of people see it that way.
But what happens to the global economy when companies like Rocket Lab own the physical, foundational infrastructure bridging Earth and orbit?
That changes everything.
It really does. If space becomes as utterly essential to daily life, global logistics, and national security as the internet is today, the ultimate winners aren't just the software companies.
Yeah, it's the hardware.
Exactly. It's the companies building the physical hardware that makes it all possible.